Well, this is an unexpected state of affairs. The market is falling. You've got Bitcoin down to my 57,558 line almost perfectly this morning. The Nasdaq's down over 2.2%. Nvidia's down 12% since it reported earnings, down just 7% on the day today, but that is still a huge number. What is going on today at the same time as we've got oil down 3.9 to 4.3%? You've got yields down about 6 basis points. My goodness, this is not the week I was expecting to come back to, especially since I just got back from a really cool vacation actually at the Kalahari Resort. I wasn't expecting this, but I have to say we went in with kind of low expectations, but this was one of the funnest places ever. Here's Jack on this this rope course with me. I mean, these places are fun. So we had a really good time there. Hashtag not sponsored. But what's going on with the market right now? Let's talk about that because now Tom Lee is also turning bearish. We'll talk about Tom Lee in just a moment, but I want to go through some of the recession indicators that we've been building up, and I want to be very clear about my positioning. And I've made this positioning very clear since about June 10th, June 11th. I believe that we're one market correction away from a recession. This doesn't mean I'm convinced we're going to go into a recession. It just means if we have a really bad stretch of market where maybe we have like 2 or 3 months of red, I think we're so close to a recession that the negative wealth effect of people seeing their stock accounts basically lose value and then therefore they spend less money, they go on less vacations or whatever, that will compress consumers enough to the point where then the layoff cycle begins and then we get the self-fulfilling consumer-led recession. I'm not looking forward to that. I think everything gets harder in society and business and startups and everything when that happens. But look at some of the indicators we have. We have quite a few. So I'm going to rush through them because you've heard a lot of these individually before, but it's nice to put them all together sometimes too. We know we've got the SOM rule that's broken the 0.5 level, which has consistently told us a recession was either here or on its way. There have been very few cases where it hasn't been accurate. And one of the cases, for example, where it wasn't accurate was, frankly, after a recession that happened right before that. You had sort of a double dip recession. The 10-2, we're essentially about to uninvert on the 10-2, which is usually the moment a recession begins. So when you get this sort of uninversion, especially coming out of the depth of an inversion, like we did over here, usually it's when you uninvert that you're getting close, kind of like a June of 07, right? Or like a February of 01, or here's another example, a July of 1990. It's usually coming out of the inversion, which is when you're closest to the recession. It's not actually the inversion itself. You could see the inversion here in 89, the depth of the inversion in March of 02, the depth of the inversion in November of 2006. There was still time there. Just like our depth was around June of 2023, June, July of 2023. We're now at that uninversion level. It's another recessionary indicator. One that I've been tracking that only usually updates quarterly, though, is also known as this real gross private domestic investment growth. That is like the biggest nasty mouthful ever, and it's really hard to track on a chart because they only update it quarterly. But I've been watching the Atlanta Fed, and they show that it's negative. Last read about a week ago was negative 2.4%. Now it's about negative 0.1%. The magnitude of negativity I didn't notice was as big of a deal though, just that it was negative. So when real gross domestic private investment growth goes negative, it's usually a sign of pessimism by businesses and households. You also have the delinquency rate on consumer loans, while not as high as what we had in 2005, higher than anywhere before the pandemic. Same thing goes for credit card loans, well above where we were before the pandemic. Look at architectural billings, which basically is sort of a leading indicator of, hey, you know, they say it's a 9 to 12 month leading indicator, but they say readings under 50 is contractionary, and we've been under 50 for quite a while now. Sitting here probably for about a year under 50 at this point, and a lot of folks are concerned that this is a tell. Yet just another indicator that we're knocking on the door of a recession. Look at ISM manufacturing. It really went negative in about December of 22, it never actually went into expansion, with the exception of one moment here in March of 2024, and it's already right back to negative, which isn't great. Then you look at U.S. construction spending, right back to negative. We can see how when we put all this together, it's icky, right? Like, I don't want to be bearish or come across as negative. I'm just saying I think there are frustrations building that can get worse if we drive further towards a market correction. Look at just some of the frustration that we're seeing amongst executives. Look at Dell, for example. I wrote this on X: shocking lack of professionalism by Dell's senior vice president and CEO, as well as the CFO, when pressed on AI-related margins. That's because Dell is known for doing server racks as part of their infrastructure solutions group. And as part of that, they do AI server racks. Well, the AI server racks are expected to lose money because they have to give big discounts to cloud service providers like the Meta, Google, Amazon to actually get the business, because it's such a competitive business. So rather than having their usual 11% margins, they might actually be negative on AI-related build-outs, basically, for server racks, which is bad. But take a look at this. An analyst here asks, hey, why are AI server revenues declining quarter over quarter? And why is your backlog flat? Is it because of Blackwell delays? Like, what's going on? Why are we seeing bad numbers? Is it because you suck, or is this like an industry-wide issue? And some of the responses you're getting here are actually more telling because of the tone and attitude you're getting from the executive staff. Look at this. Robert Williams. All right. You are all killing me on the multiple questions. Here's another one. An analyst asked multiple questions about artificial intelligence, AI server margins, and the flat Q over Q backlog. This is another analyst, right? Here was Wamsi. Here you have Ben, because they keep punting the question. Like, the executives are getting frustrated because they keep getting the same answer because they're refusing to answer the question. Or they keep getting the same question, right? Look at this one. So here Ben basically asked the same question again that somebody else asked and was unanswered. And the response they get is from the CEO, that was the greatest one question at a time of 5 I've seen. Rob replies, that was classic, Ben. In other, like, they're literally making fun of the analyst. And then they go on to still yet not answer the analyst questions. Look at the frustration here. Here's another one. The tone is just ugly. That's what's in front of us. And I think we've said each of the last several calls, and we'll say it again in this call. The margins selling to enterprises are better than the margins selling to our largest customers, the cloud service providers. Again, that frustration over, yeah, the AI margins just ain't that great, right? And unfortunately, AI is the thing that's sort of like propping things up right now. It's probably one of the reasons we didn't go into a recession yet. So those things make me nervous. Now you have to add what's happening in China, and which is one of the reasons I think markets are down today. Manufacturing in China fell to a 6-month low in August, which is leading to some of the oil declines we're seeing, which is going to be great for gas, for your cars or otherwise. But I really want you to think for a moment, what does this mean? Well, it means that we have a Labor Day sale ending this Friday, and we just had a trade just this morning up 69%. I want you to see how I send these alerts this morning, 6:40 a.m., Tesla put. I send out the ticker, I send out why, I'm sending what I'm seeing, and then 7:01, so 21-minute trade, stopped out, up 69%. Those are the kind of alerts my goal is to always send. Obviously, I can't guarantee they're always going to be profitable. Past performance doesn't guarantee future results, but my goal is when I see a trend, I send it to you. If you want those trends, make sure you're part of the Stocks and Psychology of Money group. We have the price increasing this Friday. And this weekend I didn't really pitch or do much at all because I was just playing with the kids, so sorry about that. We had a fantastic time, by the way. Really, really enjoyable time at Kalahari. It's kind of like a cruise ship on land, which is really cool. But anyway, I want you to think about this. The problem with China's manufacturing slowing down is, yes, oil prices will go down, which is good. We expect OPEC production to pick up in October, fantastic. But the problem is, when Chinese manufacturers are starting to go broke, as The Economist has told us, manufacturers may start dumping Chinese manufacturing prices, leading to manufacturing disinflation or straight up deflation. This is fantastic for companies that manufacture in China like Tesla. The bulk of Tesla's car manufacturing is in China. However, it makes every factory that isn't in China much less competitive. So the U.S. version of Tesla, Texas or Fremont, much less productive, basically. Look at Volkswagen. For the first time in, I think, their 87-year history, planning potential shutdowns of their factories. That's bad. That leads to an increase of joblessness potentially in America, as American manufacturers are not competitive, European manufacturers as they don't become competitive against the freaking out Chinese manufacturers. And so what do you end up having? A lot of joblessness. What you're basically doing is you're killing jobs in America and Europe, and you're trying to give jobs to China where it's cheaper to manufacture, although those jobs will pay a lot less. It's not great. Now, I understand September and October are seasonably very volatile. They're usually very good for bonds, which is something I've been a big proponent of for a while, really since about July, and not so good for stocks. Of course, we are also going into the election, which is usually a terrible time for stocks going right into an election. And usually, absent a recession, we recover right after the election. This is why I personally like the idea of more cash, more bonds, and go into the election, evaluate how data comes in over the next few months. Obviously, we got jobs data coming again this week, but I don't think that's very useful. I don't think it's a leading indicator. I think it's a lagging indicator. But once you start getting this unemployment cycle, the lack of investment, the unemployment cycle, that's when things just rapidly hit a wall. And I'm worried that this Chinese manufacturing slowdown is going to hit us as well. Keep in mind, we just got manufacturing data, and it wasn't good. ISM manufacturing missed again on manufacturing, so manufacturing came in slower than expected, and prices paid came in higher than expected, which is the worst of both scenarios. And construction spending came in at negative 0.3 versus 0.1% positive expected, which is bad. So I actually moved myself on the bear bull scale down to a 3.1 versus a 3.3 that I was just a few days ago. So I've been sort of bobbing around between 2.5 and 3.5 for about the last month. And it's not because I want to be a bear, it's just because of what the data is showing. And so it's kind of interesting that now all of a sudden you've got Mr. Tom Lee, who's also like, yeah, the next 7 to 8 weeks might suck. I agree. I actually think the next 7 to 8 weeks will be a buy the dip opportunity if we don't indicate a recession. But if we indicate a recession right before the election, I don't know that you want to even buy that dip. So obviously that's where we're going to listen in and stay tuned and pay attention. But let's listen to just a minute of this here.
This is one of those where investors need to be cautious, but in the back of their minds know this is a strong market.
How far down? 10%?
I think that 7 to 10 is a possibility. And we've already had 2 7% corrections this year. So it's been testing investors' patience. But I think we should expect turbulence.
There you go. Should expect turbulence, 7 to 10% correction. He doesn't think a 2% drop is worthy of buying. Wait for that at least 5% drop. I don't disagree with him here. I actually think going into an election, that's probably a very, very easy call to make, that you're going to have volatility going into the election. People, and especially the stock market, absolutely hate uncertainty. So very, very common, very, very normal. The question is, will the pain of the next 6 to 8 weeks push us into a recession? Again, because of the negative wealth effect of the market selling off, leading to worse earnings for Q3. And in October, when we report Q3 earnings, if we get companies that are freaking out, we could actually accelerate the downturn in markets and truly push us into a recession. Anyway, I try to do my best to be balanced out here. Really appreciate all of you. Do keep in mind, we're now offering licensed financial advice. This is wealth planning over at stockhack.com. We expect to start that October 1st. So right now we're really just gathering an interest list. If you want to learn more about the fees and what's involved, go to stockhack.com. But I want to be very clear here. This is designed to be a consulting business. Yes, we can custody your assets with our partner bank like JP Morgan. We're not trying to say, oh, we're going to beat the market if you invest with us or whatever. This isn't a fund. It's literally having a consultant, a financial advisor on your team that looks at your situation, your credit score, your wealth, your assets, your real estate, and says, how can we help you have more stable long-term wealth? Whether that's by buying more real estate, selling certain real estate, knowing when to renovate, when to buy the car, how to negotiate your loan with your lender. You are getting a consultant for life, we like to say, over at stockhack.com. So consider this. This is very different from, you might be a person that's like, Kevin, I'm just going to buy the dip on VOO. That's great. but who's going to help you balance buying the dip on VOO with investing in real estate or setting up your retirement accounts? Or what about tax saving strategies? Who's going to help guide you through all of those different things if you don't have a licensed financial advisor in your life? So consider some of that information. Go to stockhack.com, join that wait list if you're interested. It's no big deal if you're not. It's not the cheapest service that exists, because I actually think we are going to provide one of the best services. That's mostly because we're tying in real estate advice with financial advice, and we're really excited about offering what we think is a very, very unique service. So check it out, and you can see all the fees transparently over at stockhack.com. More information coming soon, as we're just now starting to collect an interest list in it. And check out that coupon code for the meetkevin.com courses, and we'll see you in the next one. Thanks so much. Goodbye and good luck.
These things that you told us here, I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.